Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Century Aluminum Company Annual Report. Century Aluminum Company offers a diverse range of products and services across various industries. At its core, the company produces and sells primary aluminum products, including standard grade and value-added varieties, primarily in the United States and Iceland. In addition to its primary aluminum production, Century Aluminum also engages in bauxite mining and alumina refining activities in Jamaica. This indicates a strong presence in the upstream segment of the aluminum supply chain. Furthermore, the company owns and operates a carbon anode production facility in Vlissingen, the Netherlands. This specialized facility highlights Century Aluminum's commitment to providing a comprehensive range of products and services to meet the diverse needs of its customers. Overall, Century Aluminum Company's business operations encompass primary aluminum production, bauxite mining and alumina refining, and specialized carbon anode manufacturing. Unfortunately, I do not have access to the text that was supposed to be provided. However, I can still provide a general essay on what could cause a company's stock price to skyrocket. The stock price of Century Aluminum Co. has seen a significant surge in the past year, leaving investors and analysts eager to understand the underlying reasons for this upward trend. One possible explanation is the company's strong financial performance, which may have led to increased investor confidence and demand for its shares. Another factor that could be contributing to the rise in stock price is the growing demand for aluminum, driven by various industries such as construction, transportation, and consumer goods. As global economic growth continues, companies like Century Aluminum Co. are well positioned to benefit from this trend, leading to increased revenue and profitability. Additionally, strategic partnerships or acquisitions made by the company may have also played a role in boosting its stock price. By expanding its operations and increasing its market share, Century Aluminum Co. has likely become more attractive to investors who see potential for long-term growth and returns on their investment. Furthermore, changes in global trade policies or regulations could be another factor influencing the company's stock price. If new policies favor aluminum producers like Century Aluminum Co., it may lead to increased exports and revenue, further driving up its stock price. In conclusion, a combination of factors is likely responsible for the surge in Century Aluminum Co.'s stock price over the past year. As the global economy continues to evolve, investors will be closely watching the company's performance and any developments that could impact its future prospects. Century Aluminum Company market capitalization of $5 billion is materially smaller than most of its industry peers of roughly $10 billion. Century Aluminum Company trades at a higher price-to-earnings ratio of 127 times and a higher price-to-book ratio of 6.4 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The leverage on the balance sheet appears elevated, with liabilities of 66% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have increased over the past 5 years, which is normal for a growing company. Asset and equity growth have outpaced liabilities, suggesting balanced and healthy expansion. Shareholder equity has increased on average, but the growth is not consistent year over year. This may indicate one-off events such as asset sales or capital raises, rather than durable business performance. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline in a company's financial performance can be attributed to several key factors. On the growth side, new smelter projects, strategic investments such as the sale of non-core facilities, and government incentives like tax credits and depreciation benefits have contributed significantly to increased revenue. For instance, the Advanced Manufacturing Production Credit under the Inflation Reduction Act has provided a substantial boost to production capacity. On the other hand, factors leading to revenue decline include market-related issues such as declining aluminum prices, excess capacity, and rising energy costs. Additionally, changes in customer behavior or financial condition can also impact revenue negatively. The loss of major customers like Glencore and early termination of sales agreements with key clients have further exacerbated this trend. In contrast, certain segments of the business have remained stable, such as net sales from related parties and other customers. This suggests that while some areas may be experiencing growth or decline, others are maintaining a steady performance. Overall, understanding these drivers is crucial for businesses to make informed decisions about investments, resource allocation, and strategic planning. The net income of the company underwent significant fluctuations between 2022 and 2025. Initially, it increased by $1.177 billion from 2022 to 2025, indicating a positive trend. However, this growth was short-lived, as the net income decreased by $290.9 million from 2024 to 2025. The profit margins also experienced changes during this period. The company's profit margin decreased by 13.81% from 2023 to 2024, resulting in a lower percentage of 2.58%. Conversely, it increased by 110 basis points from 2021 to 2022, indicating an improvement in profitability. The gross profit margin and operating income margin also showed variations. The gross profit margin decreased by 0.19% from 2023 to 2024, while the operating income margin decreased by 0.2% during the same period. These decreases suggest that the company's ability to generate profits from its sales and operations was compromised. The fluctuations in net income and profit margins can be attributed to various factors, such as changes in market conditions, competition, and operational efficiency. The company may need to reassess its strategies and make adjustments to improve its financial performance. The company's financial performance indicates a strong ability to generate cash from its core operations. The data shows that in both 2025 and another year, though not specified, the company has produced significant amounts of positive operating cash flow. Specifically, on page 59, it is reported that net cash provided by operating activities reached $185 million, while on page 113, this figure was $105.6 million. These figures demonstrate a consistent trend of generating substantial positive operating cash flow, which is a key indicator of a company's financial health and stability. The company's debt level has undergone some fluctuations over the past year. While there are instances where it has increased, such as a 12% rise in current liabilities and a 7% increase in long-term debt, other areas show a decrease, including a total debt reduction from $261.6 million to $227.1 million. This mixed trend suggests that the company's debt level is not entirely stable. In terms of interest expenses, there has been an increase for non-affiliates in 2025 compared to 2024, with a jump from $36.4 million to $41.9 million. However, this change does not necessarily indicate a significant shift overall, as other summaries suggest no notable changes in interest expenses. The performance of various segments and regions within the Century Aluminum Company has been mixed. On the positive side, the United States segment has seen significant developments with the announcement of a new smelter project and the sale of the Hawesville smelter for $200 million. Additionally, the Grundartangi facility is expected to receive $60–70 million in repairs from insurance. However, there are also regions that have underperformed. Iceland and Jamaica have not provided any information on their performance, suggesting a lack of significant developments or issues in these areas. Europe, while mentioned as a market served by Century Aluminum's products, has not been explicitly highlighted as performing well or poorly. Furthermore, the Grundartangi facility experienced a major setback due to an electrical equipment failure in October 2025, resulting in a substantial reduction of production. Management is optimistic about the company's outlook, with a clear focus on expansion and growth. The key initiatives driving this strategy include the investment in a new smelter project with Emirates Global Aluminium, EGA, which will significantly boost U.S. production levels. Additionally, the company plans to restart its Mt. Hawley facility, leveraging proceeds from the sale of the Hawesville facility to fund these efforts. This strategic approach is centered on expanding domestic primary aluminum production capacity positioning the company for long-term success in a competitive market. To mitigate potential risks, management has implemented various financial contracts, including price swaps and hedging agreements, to manage exposure to market fluctuations. While compliance with existing regulations remains a priority, management acknowledges that future changes in laws and regulations may pose unforeseen challenges. Overall, the company's strategy is geared towards investing in growth opportunities, increasing production capacity, and prudently managing risk to drive sustained success. The company has made several strategic acquisitions and divestitures in recent years. In terms of acquisitions, the company has partnered with EGA to build a new primary aluminum smelter in Enola, Oklahoma, with a 40% ownership stake. Additionally, it acquired a 55% interest in Jamalco in May 2023. The company also entered into a cooperative agreement with the DOE's Office of Clean Energy Demonstrations for up to $500 million in funding to build another new aluminum smelter in Enola, Oklahoma. Furthermore, the company has expanded its operations through the acquisition of the Vlissingen facility, although no specific details on the acquisition date are provided. These acquisitions demonstrate the company's commitment to growth and expansion in the aluminum industry. On the other hand, the company has also made strategic divestitures. One notable example is the sale of its Hawesville, Kentucky facility to an affiliate of TeraWulf, Inc. for $200 million. This move suggests that the company is streamlining its operations and focusing on more profitable ventures. The company's financial activities have been marked by a commitment to returning value to its shareholders. One key aspect of this is the payment of dividends, which has been confirmed as a practice undertaken by the company. In fact, it is explicitly stated that the company has paid dividends, with further details available on page 35. In addition to dividend payments, the company has also engaged in share buybacks. This strategy allows the company to purchase its own shares from the market, thereby reducing the number of outstanding shares and potentially increasing earnings per share for remaining shareholders. The company's share buyback program was authorized up to $130 million in 2011 and increased by a further $70 million in 2015. Concerns about inventory buildup and supply chain disruption are evident throughout the extracted summaries. On page 11, excess capacity and overproduction of aluminum are highlighted as potential issues, along with increased raw material costs and supply disruptions due to take-or-pay obligations. The risk of oversupply in the aluminum market is also a concern on page 12, which could lead to price deterioration and disruptions in operations. Page 14 notes electrical equipment failure at Grundartangi smelter and uncertainty about restarting curtailed capacity at MT. Holly smelter further exacerbating supply chain issues. Raw material availability is critical to profitability, as noted on page 15, and any increases in pricing or disruptions in supply could have a significant adverse effect on the business. Transportation delays due to infrastructure deterioration, page 17, and natural disasters, page 17, also pose risks to operations. Low inventory levels near all-time lows are reported on page 38, which challenges aluminum supply growth. Uncertainties due to volatility in primary aluminum sales and major inputs, alumina and electrical power, are highlighted on page 45. However, some summaries suggest that inventory levels have increased or remained stable, such as pages 81 and 104. Nevertheless, the overall picture suggests concerns about inventory buildup and supply chain disruption, particularly with regards to raw material availability and transportation disruptions. That concludes the financial summary for Century Aluminum Company. Feel free to comment below, and I will be happy to answer them when possible.